And Brian Wilson, over to you.
Thank you very much. Getting to bat first. I'll see if I can get on base any way I can, even if that's a hit by pitch. So we'll
On base percentage
yeah,
is what
on base
matters.
percentage, exactly. Let you drive me in. Great to see everyone again. We really appreciate you guys being here. And as Tim mentioned earlier, we so appreciate any and all questions. Tim and I are always available via email, so we do appreciate that interaction as well. If you don't have a chance to get on the chat today, I think I have 5 topics today. Uh, Probably won't take me too long. A couple of them are review topics, but we're at that point where it's good to review some of the concepts that we're in. Isn't this guy cute? Microsoft comes up with different screensavers periodically, but he's a cute guy. I was going to start with a topic that I visited probably 3 weeks ago, maybe 2 weeks ago. The topic is double sentiment tops, and let me show you what I mean by sentiment tops. You can probably see it a little bit easier on our dashboard, and we'll give this one a 6 month view here. So this is what normally happens, kind of run-of-the-mill interaction in trading. What you're looking at here, the green line, this is our algorithm that we call sentiment. The blue line is SPY, down below is short volume. This is very routine for the market to peak above what we call the red line. I briefly explained that in today's market desk note. And what will typically happen is, on average, this is a 5-year average, you'll have 9 trading days from red line to red line, and the market gain during that period will be 40 basis points. So essentially, the market just starts to roll over a little bit when it hits the red line. So you can see it here, market rolls over a little bit. You can see it here, market goes flatline. And you can once again see kind of that 2-week stretch, right? Here, same thing, market goes sideways. And look what's happened here. Just an extremely long period of time above the red line. In fact, I'll show you a couple of statistics here in a bit. I think this is now up to the second longest that we've ever registered. So when we talk about a double sentiment top, this is very normal. You peak, you go lower. A double sentiment top is peaking. We went flat. We peaked again. We actually went flat, and we're actually going higher again. For all intents and purposes, right now this is a triple sentiment top. So let me show you what this looks like historically. It has not happened very many times. You go back to January 2018. This was a transition, 2017 to 2018. Over the course of 9 trading days, the market quickly dropped by 10%. This, by the way, is the only time in the data that I've tracked where we've seen losses coming out of this type of sentiment top. If we look at April 2020, here's the sentiment top. We kind of trade sideways for a period of time, and then we continue to move higher. 2023, middle of a bull market. Here's that sentiment top. Once again, kind of a little bit of sideways trading, and then at month end we started to move a little bit lower. And once again, key to this discussion are inflection points. The key inflection points for you to keep in mind, options expirations and the month-end time frame. Maybe we've made it past this last inflection point being options expirations. Too early to tell, but just keep in mind the inflection points in the marketplace. March 2024. Once again, we moved higher until the next inflection point, which was once again that month-end time frame. Where are we now? Well, we're in a very, very long stretch. Here's options expirations, and this was VIX expirations right here. The next one that we'll see, of course, will be 1 week from now at month end. In the middle of this, we tracked historic high short volumes, And essentially, the way that you can think about that is this market run was so incredible. There was so much demand that there was extreme borrowing of shares to facilitate that demand. And we'll talk about this short covering here in another point. But the question right now is we're in the middle of a double or perhaps even triple sentiment top. Where do we go from here? Do we see sideways trading or additional gains into month end? Kind of like what we saw in 2020 or 2023 or 2024, or do we see declines like 2018? Right now, this is only the fifth time it's happened. And once again, three previous times we've had gains. So just wanted to provide a little bit of backdrop of where we are. And that kind of leads to the next discussion point, this very long period that we've had. It's an extreme outlier. This is once again revisiting a topic, but it's important to revisit it because it is such an outlier. What you're looking at here, and I have a ton of data points. Don't worry, I won't bore you with all of them. What it looks at this worksheet is when does the market move above the red line? When does it move back below it? What's the market returns during that time frame? There's that 40 basis points that I just quoted to you. There's the 9 trading days between red lines. And I shared this with you last week. These are the significant outliers in the data over the last 5 years, either significant in terms of negative or positive returns, or significant in terms of trading days above the red line. So right now we're in the middle of basically two different outliers. We are 22 days through yesterday above the red line, and you have to go back to 2020 November. We had 25 days. I think we're going to break that. So this will probably be the longest stretch we've ever had above that red line. The best return was also in 2020. That was in April. That was 15%. Okay, so we're in an outlier. We got it. All is well and good, Brian. What does it mean afterwards when you are in these extreme outlier positions? Well, look at 2020. 2 weeks afterwards, we were basically flat. So normal conditions are you get a little bit of a flat line, and you can see it here in most of these numbers. The exception, I guess, when we come down here to 2023, that was in the middle of a bull market. 17, 18 days. We had pretty good returns afterwards. Once again, remember, we were in the middle of a bull market. So outliers here on two different categories, both the time that we've spent above the red line, and the return that we've had so far above the red line. And what happens next? Well, we haven't gone back below it yet, so there's still excess demand in the marketplace. But this is usually what it looks like afterwards, where everything tends to just flatten out a little bit. I did mention the short covering earlier, and let's go revisit that topic. So I mentioned that, and both Tim and I have mentioned this in different market desk notes and at the demo last week. This is just an extreme outlier. There was so much demand in the marketplace that it lifted short volume at the same time. Now, normally what we will see, and I've been doing this for 10 years, Tim's been doing it for about 20 years, is that when shorts get covered, they will get covered at lower prices. Market participants who are short the shares, if they can, there's an economic incentive for them to cover at lower prices. They don't want to cover at higher prices. Well, what we saw happen recently is they did cover at higher prices. You can see the short covering, and that lifted the broad market even further. We actually saw a very similar thing happening in big tech. If we go to our big tech portfolio, and you can see what was happening for the broad market. I read a note, I believe it was last week, where about 60% of the gains for the S&P 500 in the month of May were coming from the Magnificent Seven. So, once again, just a reminder of how important big tech is to the broad market. So sentiment had started to weaken a little bit, and you can see with that, we saw a brief dip there at the beginning of May. Look at the short covering across the market or across big tech. What did that short covering do? Well, it further lifted the broad market. So we've seen short covering at elevated prices, both for big tech and across the S&P 500, and it's really continued to lift the market. I'll do a sneak peek at the what's ahead section here, and we'll pick this up a little bit more here in a few minutes. But look at short volumes once again increasing across the S&P 500. I think part of the question as we approach month end, will we once again see short covering at elevated prices? I don't have the answer to that. This is a 5-day average, that 52%. I'll take you for a second to what we call our S&P 500 report. This is on the investor relations side of the business. This is a daily read. So on a daily basis, short volumes are rapidly increasing in the background. So once again, that begs the question, will we see short covering at higher prices? Don't know right now, but that's part of what we will need to watch. I've got one more topic, and then I'll turn it over to Tim, and we can kind of conquer the what's ahead together. If we look at, here's just an illustration. I have a Bitcoin portfolio that I track. I have a number of different portfolios like this, but I just wanted to give an illustration of Bitcoin at all-time high prices. What does that look like from a supply and demand perspective? Well, if you look at demand, very, very strong, all the way up at 9, never really got that weak. It got down to 7.7776, and once again, that has increased up to 8.9. So when you see something that's doing really, really well, no surprise, demand is staying at lofty levels, never even got close to neutral. So just wanted to give an illustration. Yeah.
Really quickly, you want to show your list?
Absolutely.
Cindy, yeah, well, there you go. So yeah, I keep a portfolio just like that, just because it's a good proxy for,
Yep.
you want to know what Bitcoin's going to do. Look at the companies that are associated with. It's a good tell, and it's a nice predictive instrument. Thanks, Brian.
Absolutely. And I'll share one other thing while I'm on this topic. Mara was in our list today for daily trading ideas. And I think Tim's going to pick up on this topic as well. But just as a reminder, if you're looking for entry points, try to pick it up between the entry low and entry high. I noticed that this one wasn't doing quite as well as some of the other ones, so I picked up a half position earlier in the trading day, and I'll probably add to that position here before the close. But just an example of how to use the either the momentum or the low volatility portfolio. You're looking for those entry lows and entry highs. I mentioned in the note this morning that I picked up Dutch Brothers, and what I will do is once I pick up an order, I'll toss half of it on a limit, 2% above my purchase price, and I'll just put a good till canceled on that. And I sold half of my Dutch Brothers, I think at 5:15 this morning. And then, in an ideal situation, I'll let that other half of my position run a little bit. If it's a momentum name, sometimes you can have 4, 5, 6% upside in a given trading day, and maybe I can make a little bit more on some of those names. It doesn't always work out that way, but that's just kind of the way I've been approaching it. And Tim, back to you. Hopefully I got on base, and hopefully you can drive me in.
Okay. Thanks a lot, Brian.
Yep.
Okay. Let's see. I'm looking at where I will start. I've got 5 things as well that I'm going to cover roughly today. Bear with me one moment here as I pull this set in front of me. Okay. Let me share my screen. Okay, here we go. I put in the market desk note that I think that the conditions that developed, call it December 18, continue to exist. And I just want to point out why I think that that's the case. And it dovetails, Dan Eisenberg, with your observation that if you look at the what has happened in short volume, there's been a general change in the level. It's been a very sustained level. If you take a 50-day average, so internally we track 5, 20, 50, 200-day averages in short volume. It's a much more volatile data set than is demand. I mean, demand will reflect how algorithms execute trades over time. Supply is it's a more volatile data set because so much of it comes from market making exemptions from having to locate shares to short. So you're going to see more fluctuation in it. But the point is that really this condition where we had a very steep drop on the supply side and a long uptrend and a sustained high level has not changed. And so if the condition that has existed since we developed a lot of volatility in the market has not changed, my contention would be that the conditions remain the same. You say, well, Tim, but the market it's gone up 20%. There have been stocks, that have gone up 60, 70%. I know that but the condition on the supply side has not changed. And it's pretty telling about significant changes in I would say the global macro perspective. And demand reflects all the motivations. There's stock picking, there are indexes and ETFs and quants and trend followers and statistical arbitrageurs and market makers and long short hedge funds. All that stuff is demand. And it will all be reflected there. And then supply is the same thing. It's all going to be part of those strategies. And so at a sustained level, that hasn't changed, to me says that whatever developed back here persists. Now, I don't know what's going to happen, as I think Brian put in the note today. What I have concluded is that you cannot use historical data to know what will happen tomorrow. All we know is that similar conditions exist. But with that qualifier, that's why I think it's the case. I think that it's very possible for us to suddenly have spates of volatility like yesterday, which brings me to point number 2 on these things that I wanted to cover. And that is context. We talk all the time about BCD. We just got, because acronyms are helpful to help you remember things. We always look at broad sentiment. First thing I do every day is look at broad sentiment. I want to know what's developing on the supply side, the demand side. Demand ticked up to 7.1. It's an average. It's taking all of the components of demand. We break them into 4 categories: story, active investment; characteristics, passive investment; price, high frequency or fast trading; and derivatives. Because you can cluster things however you want, but that's how we think of the demographics of the market, and that's reflected here, plus average price performance and how each of those things affects average price performance. It's a mathematical calculation. And then we look at the supply side. And so I look at this and say, the fact that we never drop below trend, that to me is not a good sign about the durability of the market, but I could be wrong. I don't know what's going to happen. I just take the data as they come. Context. So that's broad sentiment. Context then is the cadence and calendar of the marketplace. And a lot of that are these green things. These are options expirations. There are other factors. Next week, we will have GDP, PCE, month end. I think the Russell, I should check this, the Russell rebalances peg to a date in May. I want to say it's the last Friday, but I could be wrong. I was going to send a note, Brian, to the team to say, hey, is anybody, what is that date? We have it somewhere. and maybe it's on our calendar. But all that stuff's happening next week. That's part of the cadence and calendar. It's part of context. VIX yesterday was very telling. We thought it could be volatile, and there's a logical explanation for it. The instruments that expired yesterday reset in here. The amount of volatility that was in those instruments was colossal. And then we get to where they expired yesterday, and we're at 2%. We're actually below the long run average of the components of the S&P 500, about 2.2%. But remember the 1-2-3 rule. SPY moves 1%, basket moves 2%, momentum moves 3%. That's why high probability momentum trades can give you 2%. You're just taking what the market gives. But I think a lot of people bet incorrectly. They were long volatility. It's happened to me. And they lost their collateral. So if they put up collateral, then the counterparties yesterday just went, thank you very much, and dumped it. And the market tipped over, and everybody blamed a weak 20-year treasury auction. And suddenly everybody's all worried about debt. That's not how the market works. We don't go along fully aware of the conditions in the bond market and the immense creaking weight of debt. And then suddenly on a Wednesday, the market goes, Shazam, we're concerned about debt. That's not how the market works. Derivatives, 20% of the market, very important part of that equation. Third thing I want to point out, and questions, comments, just interrupt me at any point. The next thing I want to point out is mechanics. Brian and I were talking about this. So I mentioned Duolingo, that at the point that it was in here, May 7, we calculated nothing's 100%. It's just that as I've described, and it's here, we look at the trailing 90 days, a quarter's worth, right? Roughly, it's a little bit more than that. But a quarter of a year, we're going to look at a data set and say, because things constantly change. There are quarterly index rebalances. Money comes and goes. Stock pickers have net outflows, passives have net inflows. It has to get deployed. All those things are going on. So a shorter term context gives you a higher probability of repetition. So that's what we look at. So there's a high probability that you would produce a 2% return. And that happens routinely. And it gets to why we say to do these things. If you're going to use the probability, as Brian pointed out, there are three prices that matter: the bid, the offer, and the reference price. To me, the bid and the offer is where everything has to trade. If your order is outside the bid and the offer, it's non-marketable. If it's between the bid and the offer, it's marketable and subject to instant filling, particularly if it's 100 shares or less. These are all rules of the marketplace. And so if a stock has a lot of volatility, a high probability based on the trailing data set of giving 2% or more in a short period of time, and it's sitting here in the entry range, fill it. You can always change your mind. You have to be willing to take a certain amount of risk, the risk of the marketplace. Half that. If you're going to trade ACHR and it's 8.3% volatile, you have to be prepared for a move of 4 or 5% against you. And you're not losing because it could move 8. So that's what it's been doing. So you always have to realize that and then take your gain. I like getting close to the reference price in the last 10 minutes because that's the money following the benchmark. It is 70% of equity assets. A lot of money wants the benchmark price. You're probably going to get a good average price. And there's a demand supply imbalance. And so there's a high probability of that imbalance manifesting in the next 1, 2, 3, 4, 5 days. And routinely it's the next day because high frequency traders start over at zero and start creating bids and offers. And then you see the effect of a demand supply imbalance like GME today. It was a great opportunity in the entry range yesterday, and immediately, it's up 6% today. So if you did what Brian does, take your 2%, let half of it ride, then you get 6 on that. Does it work all the time? Of course not. Nothing works perfectly, but we're trying to stack the probabilities in our favor. That's what we're doing with this data. Then I want to show you this. It's an example, speaking of mechanics of the marketplace. So this came up in a conversation with the company, with ConAgra. And it's very difficult. Their trade where they did in 1995. It's difficult, but here's something really interesting. You could go look at their holders and you would see that Pacer was their biggest seller in the quarter. And Pacer is a purely an ETF shop. They run a handful of ETFs. And it's really interesting. You could almost do the math on this, that they sold 12 million shares in the quarter, which means somewhere before March 31st. I submitted occurred right in here, in between these two short covering events. So here's how these things work. It's a good illustration. So Pacer has in a basket, maybe it's for cows, their cash cow ETF. So the basket is going to be stocks that meet criteria like that, but they want a return. Right? They're trading. They're saying like, here's the stocks we will take, and we will give you COWZ shares of the ETF. And probably money was coming out of this, and so a market maker like Goldman Sachs, authorized participant, somebody who creates and redeems, brings COWZ shares. Let's say it's 300 million of the $300 million worth. Like we want to get rid of this. And so Cowles looks at its portfolio of the stuff it's got and says, ConAgra is a drag. So we'll give you 12 million shares of ConAgra. And they do that. And so the broker dealer shorts that because it's their principal trader. And in here, they got rid of it and they covered. Now, I don't know, but it's a great illustration of how the market works. ETFs don't pool investments and deploy them. They're substitutes. I asked the BlackRock, I've shared this with you before. I said one of the senior people on the BlackRock team, how their create redeem process worked. And we walked to it. And when we got to this point, I said, would you take a single stock? I mean, what if Morgan Stanley just brought you a whole bunch of, Microsoft? And they said, we take good collateral. They did not say, oh, no, we take the basket. We take good collateral. Could that happen? Well, sure it could, because there's not a lot of stuff in the market. So it's just illustrative. These are important things to understand about how the market works. ETFs are going to move stuff back and forth. So if you go look, you can see that Pacer sold 12 million shares of ConAgra in the last quarter. It's just curious to me. I find that sort of interesting. Last thing here in before we get to what's next, I wanted to point this out. You can find supply-demand divergences. We can make this very simple. I use our daily trading ideas. It takes all the work out of it. Why would I spend 30 minutes hunting around when the work's all done for me and I can trade broad sentiment? But you can do this kind of stuff. What if you just want to find very strong divergence between supply and demand? Let's say greater or equal to 4 standard deviations. And you say, well, there can't be many stocks like that, right? Well, let's find out. So we filter for that. And here's what we find out. That this will give you everything as 1,450 stocks. That alone is telling, right? It's almost half of all the stocks in the Russell 3000 have 4 standard deviations. Well, that is a staggering number. And it speaks to what Brian was talking about, extremely unusual conditions for demand to last this amount of time where it is. And to be up more than 10 times, 15 times what normally occurs in situations like this. Now, I don't know what's going to, as Brian pointed out, you could look at the math and say, statistically, it's improbable that the market implodes. The counter argument I would make is the conditions that started December 18 still exist. And for that reason, I have this fact, so I had a huge return yesterday, thousands and thousands of dollars. All it did was get me back to level, right? It's because I have a probability-based trade. Taking 2% gains, do that. Don't follow what I do. I like to do these things because it's in my nature. But I look at broad sentiment as we come around, Brian, and you and I can talk now about what's next. This is the last thing. I look at this and say, it is such a staggering outlier. I'm always use Herb Stein's line, Ben Stein's dad, who was a, economist and financial journalist. And he said, something cannot last forever. It will stop. And if it's an extreme event, the stop could be an equal and offsetting event. Again, the data wouldn't necessarily support that. But the central tendency isn't an outlier. The outlier here is the inordinate amount of time that we have spent. The fact that we had massive artificial liquidity that fueled this run, as Brian pointed out. And then the fact that now it's reversing. It didn't go back. It didn't give us a new regime where, no, we're going to go back to 48 or 49% short in the market, which is normal and fosters a long run bull market. 5.5 demand on average, and 40, less than half of the volume short. Now it's on a long uptrend over time because there are more and more ETFs and not underlying stocks. If the number of stocks continues to decline and the number of ETFs continues to rise, what you must ineluctably get is more short volume because there isn't enough supply. So market makers are going to have to manufacture it. But it tells us that these conditions, look, if we have a sudden sharp convergence of demand and supply, it may only take the supply side. I don't know, but I'm saying it's possible. I mean, one more day like yesterday, and my returns for the entire year are spectacular because of these unusual conditions. Now, again, I don't know what if it doesn't happen. Well, then I won't be spectacular. But this is where we are to me. Brian, your comments.
Yeah, thank you, Tim. I covered part of it already. We are in extreme outlier territory. There's just no other way to mention it. I don't think I've ever tracked a triple sentiment top above the red line. I don't know if you have either. Whenever you're getting these type of anomalies, they're anomalies for a reason. And I think what I want to watch going forward is, whether shorts will get covered at higher prices. I'll share my screen for one moment. You talked about this earlier in terms of, are we seeing a change right now? Are we perhaps seeing a change in overall short volume levels? And that's certainly a possibility. If you go back, and we'll take this back to our maximum range for a moment. If you go back to 2007, 2018, it was very common to have short volume in the mid 40s. And then we went through a spell where it was up in the upper 40s and the market did just fine. So we can go through periods where we have shifts in the overall what the market's doing. And once again, going from low 40s to the upper 40s, that was a big change. We continued to, chug forward in that type of environment. Here's something to consider.
For perspective, just to support your point, to put it in perspective, if there was a 10% increase in the short side, you're talking about, in context of daily trading volume of $600 billion. You're talking about billions of dollars. It is not a small thing. You might think, well, it's just a percent or two. No, it's the degree of change that matters. And I look there and I see the long run bull market, the pandemic bull market from June 2020 to May 2021, and you look at the supply side, it was it's a very consistent pattern, very low and very similar. And so you look at the conditions now, and there's no question that the run from mid 2024 into December was supported by a general decrease on the supply side, including a big decline around the election. Right, that was a change. Now, what I would submit is that we're not reverting to the kind of regime we had in that pandemic bull market. This is something else. Now, I don't know. The data will change, it will develop, and we'll see. But to me, these conditions, I would say we could very easily, and I said this on CNBC, where I rendered myself, every time you blurt something out publicly and prognosticate, you are just branding yourself a fool. So I'm qualifying in that fashion. But
Yeah.
I think we could very easily go retest the lows. I think we're going to have more vol. Now, Brian and I debate this all the time, and I'll present data, and then he'll present data, and I'll present data. We're
Hmm.
not sure. I
It's a
went all the way back to
yeah.
2012, January 2012, because we have a very small data set outside 2017. It's like a small statistical sampling of the market, so it's not reliable. The variability is much higher. And I looked for these similar conditions and what happened. And it's interesting that about 70% of the time, after an extreme outlier event, the market is significantly lower a month out. Now, there's also that missing 30% of the time it isn't. And in the 2017 to present data set, as Brian pointed out, it would be unusual for the market to say be down 10% a month from now. And I'm not saying it will be, but I would say there is a probability. There is a probability because the regime that started December 18 is still there to me.
No, it seems like a good ending spot to me, Tim.
Yeah, I don't mean it negatively. Look,
Yeah.
isn't it awesome that you can go trade GME, Brother, BROS, make a ton of, whatever, Duolingo. You can go trade momentum names anytime, take your gains, and then you have this opportunity to make more global macro plays based on what you can see in the broad data set. And I just think it's awesome because then you don't worry. I don't care whether the market's rising or falling. All of it presents an opportunity where we can use data to make reasoned, carefully calculated commitments of capital to produce a return on investment. That's how I think about what we do. That's what we're doing. We take capital, we deploy it on a high probability basis to produce a return. That's all we're doing. And it doesn't matter which direction the market's going, whether it's volatile or not, there is opportunity. All I got. Any parting? There's this. You guys are kind of quiet today. You're not interrupting us. You go ahead. Max, thank you. Look, it doesn't work all the time, and I make mistakes. The data are rarely wrong. I, as a human being, am routinely because I'll ignore it or I forget or those things happen to us. But the data are pretty good. It's like that high frequency trader I shared with you, Rajiv Ranjan. Told me a long time ago. He said, in the midst of the financial crisis, 2008, he said, every time we overrode our machines, we got our behinds handed to us. When we trusted the data, we were fine. Because the data look, it's not because I worship at an altar of math. The math just simply reflects the mechanics of the market. And most of the times, the market will hew to its mechanics. And that's why those things work.
Hey,
So
Tim,
anyway,
maybe one quick question before we leave from Anesh. How do we use the dollars per trade?
And you can answer that, Brian. I mean, Brian says he's been doing this 10 years, but remember, he was a buy-side trader for 10 years before that. Right? So he's been doing this a long time. We like that as a measure of liquidity, Anesh. So volume is not liquidity. Liquidity is how many dollars can I move? And you could, you see where the money goes. So dollars per trade will tell you how much, what that tells us. Stocks trade, the average component of the S&P 500 trades 50,000 times a day. And how many dollars trade at a time? So if I'm a huge institution, say Vanguard running $6 trillion of equity assets in the US equity market alone, how am I going to move stuff? Well, I can't move it in something that's got $500 million of market cap and trades $500 at a time. So I'm going to look for things that where I can get thousands of dollars at a time done. And we find that unless there's at least 3,000, the price can move a lot on you. So you get your 2% and you go to sell it and you give back 1.8% just trying to get out of your position. So that's why that matters.